Hello and welcome back to another episode of the Opportunity Podcast. I'm your host, Greg Elfrink, the head of marketing over here at Empire Flippers. And you might have noticed we've been gone for a little bit, and that's because I've been literally tons of conferences over the last couple of months and simply didn't have time. Then I got sick. So there is a flurry of new content that is coming your way. And today is the start of that because today I am bringing on Crystal Stranger, who is an absolute guru when it comes to taxes. Now, this is not usually a very fun or exciting topic for most entrepreneurs, and I get it. I'm with you. But Crystal makes it super approachable, very fun to listen to, and she runs a fantastic company. So if you need help with the ever-changing rules of taxation, whether you're a U.S. individual or a foreign individual operating a U.S. company, then Crystal is an amazing, amazing resource. And I think you're going to find that out here as we go into the podcast. So without further ado, let's get into it. I'm excited to be back and 95% health. You'll hear me at the very start of this podcast probably sneezing. That's because I'm not 100% recovered yet from this wicked flu I got. But please accept my apologies for that and allow Crystal to educate you on the wonders of how to save potentially a lot of money on your taxes. All right, I'll see you on the other side. Hello and welcome, everyone. This is Greg, and today I got a very special guest for this podcast, Crystal Stranger. I met her at DCBKK not too long ago, and she is a master of something that most entrepreneurs don't like to think about, and that is taxation and saving money with taxes. It's one of those things
Yes.
that comes for us all, and we never want to think about it. So I'm glad to have you here, Crystal. For my audience that doesn't know who you are, why don't you go ahead and do a quick intro of who you are and what you've done?
Sure. Well, thanks, Greg. I'm a COO and partner at Cleer.tax, and I've taken kind of a twisty route to get here, though, I could say. I actually got into tax from real estate investment, and I gotten into real estate investment because I did drag racing at Sears Point in San Francisco many years ago, and I had been in the startup world, like started startups. I knew how difficult it was. One day I looked around the racetrack. I'm like, man, everybody who has really good cars all either own successful companies or a lot of real estate. So I'm like, I'm going to go out and buy real estate. And then I had all these questions about what was going to be my tax implications, and nobody could answer it for me because I was asking like these ridiculous, complex questions. And I ended up taking the H&R Block tax course and just to get my own knowledge. And I really enjoyed it and I got more than 100%. And they're like, please come work for us. Like, nobody does this. Nobody's actually interested in this, right? So in the process, I became an EA, worked in the entertainment industry for a bunch of years, doing multi entity type of tax returns for productions and that kind of stuff. And then ended up in expat taxation, working with people all over the world. I became senior supervisor doing foreign corporations, all that kind of stuff. Then I made the switch to Cleer, which formerly was Greenback Business Services, right? So we've rebranded a bit going to Cleer. And now we focus on corporations and LLCs, so business entities, but for founders who are located all over the world. And there's a lot of benefits with having a US corporation for fundraising, for IP purposes, for accessing better credit cards, financial system in the US, payment methods. So we help these entrepreneurs who are creating US companies make sure that they're A, optimizing the tax position, and B, like taking care of all that compliance stuff that nobody wants to deal with, right? So,
I didn't realize ClearTax was greenback.
yeah.
Excuse me. For the listeners, I'm recovering from a cold, and Crystal has been super awesome with making it convenient for me. So you guys might hear me sneeze a little bit throughout this podcast. But I didn't realize Greenback had transitioned to ClearTax. I didn't. Is there a story
Well,
behind like what happened there?
there was two greenbacks, which is part of why we rebranded and changed our
Ah,
name. So you guys, there's Greenback Expat Tax Service, which was Dave and Carrie's original company, and then Greenback Business Services was broken out from that to service C corps and LLCs and be able to assist entrepreneurs specifically. So.
I see. So you guys kind of did a rebrand because you didn't want to confuse these
We
two
had a lot of
brands.
confusion. So we had a
I
lot of
bet.
people reaching out to us for like individual expat. It's like, yeah, I have the knowledge to help you with that. That's my background, but that's not what we do. So let me send you over here, and vice versa. So it was time.
Sorry, one more sneeze. Oh, no, it's not
Do
coming.
it.
All right. I thought I was getting ambushed over here. Let's dive into the meat of this because I think there's a lot of value here. That, like I said at the beginning, like a lot of entrepreneurs don't like to think about this, but in my view, we've done over 2,000 transactions now in the marketplace, and like there's just so much power to understanding how this complexity works. So what are the most common types of taxes that businesses usually encounter? Give us the lay of the land here, just at a high level.
Sure. So in the US, there's like three basic structures, right? There's corporations, LLCs, and unstructured. So, somebody just starts a company and doesn't incorporate, they don't do anything, right? It's unincorporated business. If you have a corporation, the default treatment is C Corp, which is the one a lot of people talk bad about because it's double taxation. You're taxed corporate level, and then the individuals, when they receive dividends, are taxed again. However, it often actually is the most beneficial tax treatment now because of how the tax rates have changed over the years. So we can talk about that a bit, but you can also elect from a C Corp to be an S Corporation. I used to recommend that all the time. There's very few cases now when an S Corp election makes sense from a tax purpose. So I rarely recommend that structure any longer. Then the other main type of formed structure is an LLC. And an LLC is not a tax specific entity. So it defaults to being a pass through, either a individual, so it can pass if it's a single owner. If it's a US individual, it's reported on their personal tax return on the 1040 on Schedule C or Schedule E. But if it's a foreign person, it passes through as a foreign owned disregarded entity, and there's a required filing for an informational return. But if there's no US source income, that non US individual actually doesn't pay any US tax on that income. So it's kind of an interesting little loophole. The default treatment, though, if there's two or more people, is a partnership, which has to file a separate return, and then it passes through the income to individuals. But for foreign individuals, it's not quite as beneficial. There's some pros and cons there. And then an LLC can also file elections to be a C Corp or an S Corp. But in most instances these days, I don't recommend filing the elections for LLCs because, especially for entrepreneurs who are operating in the software space or operating internationally, because an LLC that's taxed as a C Corp isn't eligible for the foreign derived intangible income discount, FDII for short. And
Yes.
FDII is super valuable because it allows all your sales made outside the US, if you're providing a service from outside the US, or if you have, say a SaaS product, something like that, then you're able to have a reduced tax rate that's an effective 13.125% rate rather than the 21% US tax rate. So even if you're having like some double taxation with treaty rates and all that, it often is much lower when you do all the math to have a C Corp, especially if you can, be able to utilize FDII and get that super low tax rate.
So the common wisdom I've always heard is just do LLC, don't do a C corp, don't bother with all that. But it sounds like that's the wrong move from what you're saying. Maybe what we
Well,
we
it
could do like a high
depends.
level overview of the difference
Yeah,
between LLC and C corp.
yeah. I mean, it depends what kind of business you have and what you want to do with it, like what your ultimate goals are. And then also, like, where the owners are located, right? How many owners there are, if you have one owner, if you have multiple founders, where you're located. So, where an LLC is most beneficial is if you have a non US person who's providing a service from outside the US. They want the LLC to be able to transact, invoice, some of that kind of stuff. and they're able to pass through that income to themselves where it's not taxed, right? So that's the biggest use case, is those foreign owned disregarded entities. It also can be beneficial in a lot of domestic instances in the US. Like, for example, for a vehicle to like hold real estate in, you don't really want to hold a property that's going to appreciate in value greatly in a corporation, because you'll get killed on the back end when you sell that. It also can be good if you're building, like with that in mind, if you're building something and your intent is to sell it in an asset sale. Like, going into this that it's somebody's going to want to buy what you're creating to add to what they're doing as like that kind of strategic acquisition, and not buying your operating company, right? You're building a SaaS type application that you can picture somebody adding to a portfolio of other SaaS companies that are already in existence. It's going to be an asset that's acquired. Well, then the LLC is a much more beneficial ownership structure to have. C Corps, on the other hand, if you have multiple founders, there's a lot better standard agreements out there when it comes to vesting and everything like that for C corporations. There's also the QSBS that can allow you to have tax free income when you do get an acquisition as a share acquisition. Foreign individuals who own shares in US companies and sell the shares and not the assets, actually, that sale of shares is typically tax free to them if they're not a US person. So there's a lot of advantages and disadvantages on both entity types.
Which one would you say? And I'm sure this depends on the scenario. Maybe you could run us through some of the scenarios. But let's
Mm-hmm.
say I'm a e-commerce owner, 7-figure business, maybe multiple 7-figure valuation. I go to sell. Did I make a mistake by being an LLC versus a C corp in this case? Because usually it is an asset. So you just said LLCs are
Yeah.
great for selling assets. So maybe that is the right way to go. Like, kind of scenarios should someone play out in their head if they are building out like a big e-commerce brand and they want to structure this right for
Yeah, absolutely.
maximizing the exit?
So for e-commerce specifically, there's two issues that kind of can lean one way or the other, right? So the acquisition end of it, you're definitely better off as the LLC, because then the income passes through on the asset sale just like any other kind of income. Whereas with a C corp, you're taxed at the corporate level, and then if you distribute the funds from the sale to yourself, you're taxed again at the dividend level. However, a lot of e-commerce entrepreneurs I've seen who are in that situation with the corporation, they pay the tax at the corporate level and then they reinvest and build another business, right? Because I'd say a lot of people in the e-commerce space, they're not building a single brand or business and then selling that and going out of that world. Most of the time, from what I see, they're kind of serial entrepreneurs. They build one successful business and then they roll it in and build another business line, right? So if that's your intent, you may actually have lower tax with a C corp, because generally, like, the C corp tax rate is a flat 21%. So it's usually a lower tax rate than the individual rates will end up being on that income. On the other issue, though, that I mentioned, so I said there's two issues. That's one that could still play out either way, depending on the goals. But the other is, signing contracts and contracting, and the always overhanging 1099K deadline that keeps getting pushed out there, which is so right now, if you sell in the US and you sell on like an online platform, the rules that apply are, if you have a over $20,000 in sales and at least 200 transactions, you receive a 1099K at the end of the year. The rules for reporting on 1099Ks are usually a little different. And typically, there's a higher amount reported there than the amount received in the bank account. So it can cause tax letters, issues, things like that to come up. It was supposed to be issued for anyone receiving over $600 last year for 2022. At the last minute, the IRS delayed it. They've delayed it once again now. And now for the
Shocker.
year 2024, so starting in 2025, they say they're going to be issuing 1099K forms for those who receive over $5,000 in income. So that's the new rule going forward. The thing is that when these rules actually start getting assessed and the companies are looking for all their W8 or W9 forms rather to be completed by the sellers on the platform, an LLC can't technically sign the W9 form if it's a disregarded entity. It can only sign the W9 form if it's a partnership or a corporation. So, an instance I've
Just
seen a
real
lot.
quick, what would be a disregarded entity? I'm not familiar with that term.
Oh, sorry, that's an LLC with a single owner, right?
Gotcha.
So the LLC with a single owner would have to sign the W9 form under their individual name. If they're a non-US person, they wouldn't be allowed to sign W9. They would have to instead complete W8 Ben, and the e-commerce platform will take out 30% backup withholding from their payments at that point on, right? So that's the big risk with LLCs is at some point when the e-commerce platforms out there decide to start enforcing these 1099 rules and collecting the W9s properly, when they think the IRS is going to hold them liable for it at some point in the future, then there's going to be a lot of LLCs that find themselves in a situation where they get email or letters saying, hey, we need you to complete a new W9 because as an LLC, you can't sign this form, right? So, and my experience with entrepreneurs who have been through this, because there was a crackdown like this by some of the e-commerce sites. So Amazon did it not in their e-commerce, but in some of the royalty agreements that they had started going through and sorting out the LLCs and making people sign new W9 forms back in, I think it was 2000. So, right before the pandemic, they sent out a ton of letters like that. So, it was back in 2000. I saw that a lot. And Microsoft also back in 2000 had been doing that. But then it seems like everybody kind of pressed pause with the pandemic and, the IRS issues, and IRS paused it. So eventually, though, this issue will come back around, and anyone who sells e-commerce on online platforms, there will be more enforcement with utilizing an LLC for that entity.
Interesting. So, in a lot of ways, if you are a seller, like you sell at that seven-figure e-commerce store, if you're a C corp, you're better off. Like you may not take any money out from that sell, but you use it to reinvest, and then the tax rate is just much lower than the LLC. From what it sounds like, if you do it that way.
Yeah, absolutely. I mean, there's a lot, I mean, I'd say that's true in most cases. There's some
It
instances
always
where,
it depends.
there's always exceptions, right? I mean, that's the challenge of this, and it's a really fun part of this also, is it's like piecing together puzzles all the time of like, how can
The
we find
Byzantine
the
tax system. Yeah.
way that like we can structure this that maximizes the value for everyone, like with the goals, with what's going on, and then also looking for, what else might be an issue, like, these other things on the horizon potentially.
I remember this years ago. I think it might have been 2018 when we started selling a lot more e-commerce. Like we had
Mhm.
already been selling quite a bit, but that's when things are really ramping up for us in the marketplace. And I remember a lot of the entrepreneurs just like pulling their hair out over Nexus. And, like a lot of them
Mhm.
just like, I have no idea what to do with this, and just basically gave up. Like when the IRS like sends me in the fine, I'll know what to do. So maybe we could talk about that. Don't know how familiar you are with it, but if you are, maybe you could explain what Nexus is and how this affects e-commerce entrepreneurs.
So for Nexus, are you talking about sales tax or income tax Nexus? Because they're
Good
both
question.
they're
Yeah.
both slightly different.
So
I
I
imagine it'd be sales tax
I think it's
with
sales
the
tax because
e-commerce
the
issues.
yeah, the
Yeah.
issue that they were facing was like, I'm a company out of Washington selling to California
Mhm.
and Idaho, and now I have like not just state by state sales tax, but sometimes county by county sales tax. And it sounded
Yeah.
like, wow, that sounded really messy to me. We've had like some brushstrokes with Nexus ourselves, and yeah, it's not a very fun thing to deal with. So yeah, I'm assuming it must be sales tax.
Yeah. So about 4 years ago, there was a Supreme Court case called South Dakota versus Wayfair. And if for anybody in, who wants to understand about sales tax nexus, it's a really fun read, but it's actually really well written. But I remember, hearing a lot like ABA conferences and everything right after that about how this was opening a Pandora's box for states to change how they're taxing, with sales tax specifically, but also income tax. And since that time, in the last 4 years, it's changed so quickly, especially with the pandemic, states trying to raise additional revenue. The rules have changed more times than I can count. As far as sales tax goes, prior to the Wayfair case, there were a couple long-standing cases. One was from, I think, like late 1940s with International Shoe, and then
Wow.
in 1994 there was another e-commerce case specifically that said you needed like to have actual ties, physical ties in the state. You needed a distribution center, an employee there, like other than a salesperson, because there's a salesperson exception. But so there was this long-standing precedent for this. And Wayfair completely turned that on its end, said that now in the digital economy, it's unfair for people to be able to order online and states not to get their shares, and that the responsibility for collecting that should be on these platforms, right? And on digital sellers online. And
Wayfair was
that's
saying this.
that's what the case said. The
Okay,
Supreme Court
gotcha.
said that.
This,
That's the
this
Supreme
seems like
Court
Wayfair is
reason.
fighting against themselves.
No, 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 not Wayfair. Wayfair wanted it the other way. They
Yeah,
were
yeah,
fighting the
okay, all
case
right.
to the
I'm
Supreme
tracking
Court.
now.
No, it was South Dakota going after Wayfair for money, right?
Yeah.
That's what the case was. So ever since then, basically every state has rolled out new Nexus rules to try to collect some money from e-commerce going into the state. Generally speaking, if you're using like, what is it, the FBA, Amazon, or other kinds of drop shipping, you're probably going to have Nexus just about anywhere your customers are because, those big drop shipping services have distribution centers and physical locations almost everywhere, right? But if you're shipping in using common carrier, from like say China, that the goods are going straight from China to the person in Iowa at their house, it's more of a gray area and it's less likely that you would have nexus on that. So that's for e-commerce, which is the fairly straightforward area, and there's a lot of good information. I can share some links for you on that. Then it gets more complicated when you start to look at other business models like software, for example. So software, it used to be a physical product. So some states have taken this, position that because it was a physical product, they're losing out on all this money. So any kind of software sold, if it's a digital download, if it's software as a service, if, it's any kind of digital access to it, like customized software even, it's taxable. Other states have taken like, a hands-off approach, like, no, we're not going to tax software. And then there's still a lot more states that fall in the middle and say, well, we're going to tax physical software and maybe digital downloads, but not SaaS products. So it's really convoluted there. And typically also the distribution then of about roughly half the states, tax SaaS, for example. And those states that do, then you have to go through usually once a year and look at the company and if the sales in that state reach the threshold where you need to start doing that reporting. So that's normally the approach I take on companies that are getting bigger, and we'll get there. You can do a lot to minimize the exposure in that area. For example, you can, kind of target your marketing geographically in order to, target states that either you've already had to register in or have really high thresholds. So there's a lot that can be done to minimize exposure as well.
So each one of these states has a different threshold. I'm assuming it's a sales volume that you have to do to
Yeah,
cross that threshold.
every states have different rules. They usually
Love
all have an
it.
economic threshold and a number of transactions. It used to be like 2 or 3 years ago that you had to meet both the economic threshold and the number of transactions. Typically these days though it's an or. So if you have a lot of really small like micro transactions, like you charge a lot of $1 sales, you could be really likely to meet sales tax even when you'd have practically nil sales in those states. So that's just on the sales tax side. For income tax, it's completely different. So the general nexus for sales tax is where your customers are located. The general nexus for income tax is where your company's located. So where your company is, organized, registered, you use addresses in, you have employees, you have independent contractors, where you maybe have a distribution site, drop shipping servers. These are like unknowns out there. So, there's always unknowns where sometimes it depends, like, how conservative do you want to be? How aggressive? Bless you. And
Thank you. Don't mind me. I'm just falling apart over here. All this
oh
Nexus is
no,
getting to me.
it's overwhelming. It's like you feel stuffed up just thinking about it.
The bureaucracy of it all.
It's maddening. I mean, it's just so insanely complex sometimes to have to look at this. But, luckily, the vast majority of companies are under those thresholds and they have very few requirements. It's more of just checking and making sure and verifying that you don't have exposure, right?
So this might be a naive question, but I imagine there must be tools out there nowadays, at least for e-commerce, and I would think for SaaS too, where,
Mhm.
say I'm buying a product, I live in, I don't know, Idaho, that on the checkout it just automatically adds in the sales tax, like you would add like a gas station in Idaho buying something, right? Is that something that e-commerce owners can do to kind of like, I don't know, simplify this entire process, or like what would you
Yeah, if
recommend?
if you have Nexus and you need to collect sales tax, you need that kind of software. You can't do this manually. It's too
It must
complex.
be
You're
an
going to make
absolute
mistakes.
nightmare. Yeah.
And it's basically, because every like city and town and county within a state will have different tax rates.
Yeah.
So you would spend so much time looking up every single transaction, where that's located, what city, state in it is. It's just insane.
Yeah, and that would
There's
change your
two.
margin so dramatically too if you didn't add on
Oh,
top of it.
yeah.
It would be so
Well, I
hard to
mean, even
plan for it.
having to utilize one of these software platforms can, like, the best software platform out there is Avalara, hands down. But from what I hear from clients, it's just insanely expensive. If you're looking at 50 state compliant, it's over $50,000 a year, right? So it's just out of reach for a lot of people. TaxJar, that was bought by Stripe, is probably the next best product. Although, I don't know, I've heard some questionable things back from clients recently, which is a bummer because everybody loved it until recently. So I'm not sure what's
Try
happening
pouring that
over there.
magic on
It's a
it.
bummer. It's a bummer. Yeah, no, I mean I love Stripe. Like, we're Stripe partners. I love Stripe. Like, their Atlas formation is amazing. I recommend that day in, day out. But yeah, I don't know. I used to just tell everyone, "Oh, it's so easy. You go do tax jar." And then, just this year I started hearing some feedback where maybe I have to be a little more careful. But it's
But you
definitely, I'd
just
say,
only
the
have to
best
you only have to
best
change one
middle.
word of your feedback. Instead of saying it's so easy, just say, "Oh, it's so complex." Easy.
Yeah. I mean, I'd say it's the best middle ground out there, though, still, for entrepreneurs. And I mean, and a lot of e commerce sites have that kind of technology and tools built in as well, right?
Right.
So,
Right. I see why my friend just kind of gave up just for this brief talk and like my own brief experience with Nexus. So like ours is I forget exactly why we had to do it. I think it's because we had employees living in different states, and that's
Hmm.
what like kind of triggered it. And so they're like, "All right, we've done this for like 6 states. No one can live anywhere else but these 6 states or outside of America." Like, it's just so like I
Yeah.
have friends who are California suddenly find themselves, oh, I've got to become Texan now. So it just was a nightmare for us, and I can only imagine it being like 20x worse for my e-commerce friends. So that was an
Yeah,
interesting
that
dive.
sounds like it would be payroll, qualification, and income tax nexus
Yeah,
when it's
yeah.
related to employees because it's where your company is.
Yeah, yeah, and I imagine the sales tax thing is way more complicated with how much differences there's. But I did want to talk to you about lowering your exposure to these taxes. But before we do that,
Hmm.
you have tons of experience. Obviously, you've worked with a lot of entrepreneurs. So, in your experience, where do entrepreneurs just completely mess up on their taxes? What mistakes are they making, especially when it comes to selling their business?
Well, I mean, I'd say the number one is not filing taxes. Uh,
The classic, the
that
go-to
that
strategy of every entrepreneur: out
I
of
mean,
mind, out of sight.
it sounds like a stupid answer, but you'd be surprised how many people come in
First of all,
3 years later. You
I
know?
am not surprised at all. So we do SBA, right? Like, or we've tried to, I
Yeah.
should say, and like every time the SBA lender is like, "Oh, your tax records don't line up with this." It's like, this is why we don't recommend any buyers to do SBA, because like it never lines up. There's so much work that goes into like making it all in alignment again. So yeah, that does not surprise me. That was your first thing to
Yeah.
say.
Yeah, I mean it's crazy, especially if it's a foreign owner of a US company, because there's Form 5472 that has to be included to reportable transactions of a foreign owner. So especially foreign owned disregard entities, so that LLC owned by a single foreign owner is the worst because it's an automatic $25,000 penalty every year that it's not filed. And those penalties are so hard to get waived because they're international information return penalties. The IRS takes a really hard nosed approach to them. And even with like reasonable cause, it's a little bit of a crapshoot. Like we get a lot of them waived. We do have a lot of success in our resolution, but filing is so important. Like even if there's no income, no deductions, no anything, just file. It's not that expensive. It's not that difficult. Just get it done. But I mean, I'd say like that's the biggest thing I see tripping people up because they'll file multiple returns right before they decide to sell their company. Then they'll get the penalty of $25,000 from the IRS, and they'll essentially be forced to pay that because they don't have any leeway to resolve it because it can take up to 3 years to resolve those penalties. So
And by resolve,
that's
you mean lowering the actual penalty, or because I'm assuming the IRS will let you pay
yeah,
that right away.
getting them removed,
Gotcha.
like fighting it and getting it removed. But even if you have grounds to get it removed on, like a first time abatement or reasonable cause, someone was hospital war zone, whatever else, then it's still going to take up to 3 years to do that. And whoever's buying your company is probably going to want to see that resolved before they buy your company, unless it's an asset purchase, right? That's why those are a little easier. The next biggest issue I see is using state addresses for vanity reasons. So, a lot of people love having a California address, a New York address to make their company look like big and cool and that kind of stuff. Or they just sign up for a mailing address and don't pick where they want it to be and get a default location somewhere else. And that can create tax liabilities in those other states just by having an address and putting it on your website, putting it on your mail and communication, your invoices. In California, that's enough to create income tax nexus and make you have to pay at least the $800 a year minimum tax in California, right? Plus
That's
penalties
amazing.
and interest and all kinds of stuff.
We had the opposite of a vanity address. So I believe we're a Delaware incorporated, like a lot of companies are,
Hmm.
right? But I
Yeah.
don't think we really thought about like our address. We're like, yeah, whatever is good. And then I started showing up on like Google Maps, like, oh, this does not look like a good neighborhood. Everything's kind of like ran down and broken. Like, yeah, Empire Flipper is like we're in this broken strip mall. Yeah. But we're like completely remote company, right? We have no offices, nothing like that. But
Yeah.
every now and then, like a friend of mine will point out, like, "What's this deal with this Empire Flippers place in Delaware?" Like, don't worry about that. I promise you, we're not nearly as shady as Google Maps makes us look.
That's hilarious. I love that.
That's
Yeah, but I
changed
mean, at
now,
least
so hopefully
from,
Google
from
update its algorithm soon.
yeah, from a tax perspective, though, you were in good shape with a Delaware address. Although, if you
Yeah,
have
yeah.
employees in other states, you might as well use one in one of the states where you have an employee. So,
Like, direct to Silicon Valley, the one way ticket to the highest taxations.
yes.
So you mentioned, how this makes it easier if you do an asset sale. So this is something I wanted to talk to you about. At EF, we do mostly asset purchase agreements. So like in the case of like if a seller does have these fines, it's not that big of a deal to the buyer because they're just taking the asset. But with that said, we have done stock sales at certain times, and
Hmm.
like we haven't done a ton. Usually it involves UK companies. Sometimes they will want to do a stock sale. Sometimes American companies too, but and usually it is for tax reasons. So I'm curious, like, because I never understood like how these differ. So maybe you can enlighten me and my audience. Like, why would someone want to sell as a stock purchase type
Sure.
of sale versus an asset sale? Like, what are the tax
So let
liability
me
differences?
let me give you a rough example. So let's say you have two entrepreneurs from non-tax treaty company, let's say Ecuador or something, for example, right? And they own a U.S. company. They build something super cool, and they get offered $1 million for it. They like are like, yay! We've never even imagined we'd have this much money. We want to sell it, right? So if they sell it as an asset sale, 21% of that $1 million right off the bat gets paid as corporate income tax. So they're left there, with what, 790,000, right? And then out of that, for what they want to distribute for themselves, they have to pay a 30% tax on. So at the end of the day, they're receiving 553,000, a little more than half out of that $1 million sale. Still a lot of money for them, but not as exciting as when like the
Yeah, the big
strategic
seven figure.
acquisition
Yeah.
came and said, "I'll give you $1 million," right? It's like, man, what do you mean? Like I'm losing half of this in taxes, right? However, if instead they sell it as a sale of stock, and whatever acquiring company pays them $1 million for their stock, they might even pay them like a salary to stay in and meet certain metrics or other things going forward. That's pretty common, but let's just use the million as a base point. They're able to sell that as the sale of the stock and have zero tax liability in the US on it. And
And
it's
that only
possible.
works for non-Americans?
Only works for non-Americans. So it's
Gotcha.
possible that they'll have tax in Ecuador on it, but a lot of these non-tax treaty countries, they don't tax income that comes from like your investments abroad. They only tax you on your resident income.
Gotcha.
So for them, like receiving that for selling property that they owned outside the country, it likely would be tax free for them in their home country too. So it can make a massive difference where even if, the purchaser that's paying the $1 million holds back 120, 150,000 for tax liability, then it still is so much more money going to the sellers. So
That makes
that's
sense.
where stock sales can be beneficial. For US citizens, it doesn't matter so much one way or the other.
Uncle Sam
Uh,
will get you.
Yeah, because I mean, if it well depends again, if you qualify for like the QSBS, you've met the holding period. I think it's like 5 or 7 years from the issuance date. It's original issuance stock. Like there's a whole bunch of rules. Then it's a tax-free gain also, right? So there can be tax-free gains also for US sellers if you're selling the shares of the corporation, but the rules are tricky, right?
You have to
So
hold the company for 5 years to be able to do that. I always thought long-term capital gains started at 2 years, or am I wrong in that?
no, this is the QSBS. So
QSB.
it's like a qualified small business stock
I see. I
deduction.
see.
So it's a separate like category of it's aimed for investors to invest in early stage companies with an original share issuance, hold their stock for the long term. So this is typically the reason why in like the VC world you'll see a lot of like safe notes and other types of things, and then all the early stage investors will come in on like the B or C round in one like original issuance purchase, right? Is that those original issuance shares qualify for that QSBS deduction? And I could have my numbers off. It's been a while since I worked on one of those, but I think it's up to like 10 million worth of income tax free.
Wow.
So,
Just going back on that for people in our audience that are buyers, like I have certainly seen where buyers have actually gotten a pretty decent discount on buying businesses from us when they convince the seller to do the stock sale for probably exactly the same reason that you just described. Like the seller selling the business for less, for like, I don't know, 100 grand less on that $1 million deal, but they're actually walking away with like, 800 grand, 900 grand in their pocket instead of 500 grand. So like
yeah.
that's a useful negotiation tactic in general, I would say, from an M&A perspective. On the flip
I'm
side,
yeah, it is a little more liability, but yeah.
right, yeah, that's an important thing to bring up too. Like with stock sales, you end up getting the liability. With asset sales, there are no liabilities. Though I'd be curious on your take on this. In my, guesstimate, I would say buying like a SaaS business or e-commerce store, the chances of you having some like shocker liability, I would say is a lot lower than like if you're buying like a warehouse or a factory or even like a
Oh
more traditional
yeah.
mortar business. Is that true
No,
in
I
your
mean, I
experience?
mean, I'd say it's extremely low. I'd say tax is probably the biggest area of liability and where I see the most money held back in deals after like the full legal due diligence is done. You know, the other areas, if you're talking trademark, that kind of stuff, you have kind of the same risk when you're buying asset sales anyway,
Yeah,
right?
yeah.
Like if you're, honestly, I don't think there's a huge risk there. I've always been a little surprised when I, counsel clients in very similar situations to that and give them what the tax outlook looks like. They go back to the buyer and they say, no, absolutely. All we want is an asset sale. That's it, or the deal's off the table. And it's like, wow, you think you could go somewhere in between and negotiate a bit there and get a better deal for everyone, right?
Right, right. That's curious that the seller would be so wanton for the APA because usually like the buyers want the asset purchase agreement because they don't want the liabilities. They want like the skeletons in the closet coming
Oh,
out.
sorry. No, no, I meant the buyer.
Oh,
Buyer
okay.
wants it, and the seller.
All right, that
The
that makes more
seller.
sense to me. Yeah, yeah.
Yeah, yeah, yeah. The seller doesn't. Yeah, yeah. Exactly.
Speaking of skeletons in the closet, so I'm curious if you've ever seen this in your work. So I have a friend; he's a prolific business buyer, and he does do stock purchases as well as asset purchases. He does both, and
Uh
like
huh.
whatever makes sense for the deal. But one of the ways he protects himself is using representations and warranties. So, like for example,
Yeah.
that person with the multiple 25K tax fines, if that was found out
Yeah.
after the transition, he would have those representations and warranties trying to safeguard him from having to pay that.
Yeah.
Say that liability is still on you, on the seller. Have you seen this play out in your own work?
I've seen that in a lot of contracts, and I see that even in the asset acquisition deals a lot of times, right? So, it's pretty common, I'd say,
Okay,
to have
cool,
that.
cool.
Yeah.
He's one of the only people I know that's
That has
spoken
asked for
about
it.
that. Yeah.
Interesting.
So, like, I
Yeah.
mean, most buyers I've seen don't do that, and I think that's really smart. I mean, and it doesn't have to be just taxes, right?
Yeah.
It could be
Yeah.
multiple things that you have representations and warranties on. It's a kind of a more advanced way of thinking as a buyer, I suppose, versus someone starting out.
I would say though that actually on the other end of your other question, that I do know sellers who prefer asset sales. And I know like some sellers specifically who like to do asset sales. They like to schedule it for early in the year and then reinvest the proceeds. Because if you reinvest everything by the end of the year, it's tax free again because you've spent as much as you earned in the company, right? So if you can time it where you can close your acquisition sale, which usually, like, the big benefit of selling an asset is it's much faster and much easier, right? And I've had, a few clients who sell companies repeatedly with the intent they're going to take it, build another company that's similar or different, and then they utilize that, launch the next company, and beat their tax amount down to really low on the asset sale. So that's
I've
another,
definitely seen that as well.
yeah,
Though I didn't realize that on the tax part of it, but that does make sense. I'm curious on your thoughts on this. So a lot of entrepreneurs, they do try to lower that tax burden through like what you're saying, right? They sell an asset or
yeah.
like go crazy, their own drag racing to try to spend as much of that money as possible right before the
It
end of the
doesn't work
year.
to do drag racing. Don't listen.
Yeah, just like
It's
burn
a
it. I
hobby.
have a,
You
I have a
can't.
friend he spent like $200,000 with us just to save money, and like he ran into what where I'm getting to with my question, but like he spent that 200 grand, right? And those
Yeah.
businesses didn't go well. Like so, basically, it's $200,000 of waste because now, yeah, you didn't have to pay taxes on it, but now he just also doesn't have it. What's your thought on that balance, like for an entrepreneur?
Well, A, I don't think your friend was making a very smart investment tax wise either,
I
because
think he
when
would
you're
agree with you
purchasing,
after he did it.
yeah, when you're purchasing assets, you actually don't get to deduct the full amount of the asset in the year that you purchased it. You
Oh,
have to
really?
deduct it over time, so you have to
Yes, they have no
amortize
reason
it.
to. Yeah, yeah, yeah.
Yeah.
Yeah, I didn't think
So
about that.
that's,
I don't think he did either.
yeah. Yeah.
So this is
So
even more worse for him.
So yeah, when I'm talking about going out and spending, I'm not saying about buying business assets necessarily. I mean, you could if it's like physically in the US and you're buying depreciable assets because you can take bonus depreciation and accelerate it. But if you're outside the US, you're working with digital businesses, you're better off investing that into, like, creating your new company. Marketing in particular is always a good expense. You also have to be careful, though, when it comes to software development because of Section 174, which was part of the Tax Cuts and Jobs Act. And nobody ever thought it would see the light of day. It was like a budget balancing measure to afford the 21% corporate tax rate cut, right? And it was supposed to be repealed last year, January 2nd. Congress went in to vote on it. The Democrats showed up and said, "We want a bigger child tax credit. We want to extend this." Republicans said no. Everybody walked out. The bill got voted down, and suddenly we were stuck with this crazy law that, overturns again precedent from like the 1950s that allows, entrepreneurs to deduct in a current year research and experimentation expenses. And it had a line in there. So any and all software development, which was terrifying when you read that, because one line of tax code is so vague, right? It could include absolutely anything under the sun that touches a computer, right? Luckily, in September, the IRS finally came out with guidance about this, and they actually came up with the same best practices almost exactly that I had created for our company of Cleer to be able to follow internally. But essentially, if you're developing a new company, if you're going out and it's an e-commerce company, you're buying a ton of inventory and stuff, like, that's fine because, like, buying inventory is, well, it can be a current expense, depends how you treat it. Actually, inventory should be carried as a capital asset with inventory to the next year. Depends how big it is, depends what you're buying. There's a whole lot of issues there. So yeah, I have to cut myself off on that one. That's complicated. But on the other end, if on the other end of the spectrum, though, if you're developing like a new software or SaaS platform, now you have to capitalize that over 5 years if you do your development in the US, or over 15 years if you have it done overseas.
Wow,
So that's a big, it's a big, big
that's
issue.
a big hit. That's interesting. So if I sold my company for $1 million, I would not benefit that much by turning around and buying more profitable companies. And from a tax strategy perspective, from the sounds of it, I'd be better off starting something from scratch. Probably not software where I spend a lot of money on marketing.
Yeah, exactly. Like, so if you wanted to take that $1 million into your company and grow it, I mean, you could buy an existing company, especially if it's inventory rich or if it has, other elements. And yeah, you're going to have a little bit of capitalization there, but, then be intending to put the bulk of your money into marketing and growing it. So, like a really good website, SEO, like,
Marketing agencies are
advertising.
loving this part of this podcast. Yes,
I
let
bet
us
they
save
are.
you on
Yeah.
taxes. That is why we
Hey,
were
well,
made.
I mean, as far as like taxes go, it's one of the better things you can spend money on because it generates you revenue, but it's, pretty much always allowed as a deduction, right? And it's
Right,
and it's airy. It's not, tied to any like specific location dependence or anything like that.
right.
Yeah.
How would it work in, let's say, in a more complicated, maybe I only think it's more complicated. You have probably a better handle on this than me, but let's say I sell my company and I start a Holdco. So the business of that business is to acquire businesses. Would that change the tax scenario here? And because like the business itself is to acquire businesses.
Yeah, so there's a couple issues with that. One is sometimes when you're converting to a holding company, you actually would have a deemed dividend that would be treated as a dividend from it in order to up your basis because you technically can't have more than $250,000 of retained earnings held in a C corp that isn't already like earmarked for growth, right? So if you don't have a business plan idea how you're using that money, you have that $1 million come in and it's a holding company, you're buying a whole bunch of other investments with it. It's getting into a gray area where depending how active those investments are, it could be allowed or it could not be allowed,
By
right?
active, do you mean like, the difference between buying like more passive real estate versus like a inventory rich business like an e-commerce store? Is that what you mean?
Yeah, so I mean, an e-commerce store or, a software SaaS company or a travel business that's service related, like all of these things would be active businesses, right? But there's a lot of, passive businesses like, buying real estate or, buying a yacht and, having somebody manage it and putting it into a yacht pool, right? Lots of people try to take those kind of deductions and they're really hard to sustain because you have to, you have a big burden of proof to show these kind of like passive activities are actually active legitimate businesses. And even worse is the hobby businesses. So you mentioned drag racing. Drag racing is one of those things like, you know helicopter company, which I worked at a lot of helicopter companies that were legitimate businesses, but a lot of people buy a helicopter, start a helicopter company, and don't really run it like an active business, right? So those get audited really frequently from the IRS. A lot of like gentleman farming, like buying a horse ranch and like,
my
doing that.
I never thought
Yeah.
about it, but I think my dad did something like this. So my sister, when she got married up in Alaska, they had this big limousine, right? That they went off on a
Hmm.
honeymoon. And my dad thought it'd be really cool. Like, what if I bought that limousine? So him and one of his clients bought this limousine, and it was technically a business. Like there was a chauffeur that you pay to drive you around, but the only two
Yeah.
clients were like my dad and his business partner. So like, yeah, he kind of had this bit of a hobby gray area kind of business going on with this limousine.
Exactly.
Yeah.
Exactly. Yes, that's the kind of business that if you continue writing losses off for like more than 3 years, the IRS will come in and say, "Hey, this isn't really a business. This is a hobby.
It's not going
We're
real
going
well
to
for you.
tax you."
That's funny. Well, guys, we're already getting close to coming up on time. You are a wealth of knowledge here. Before we get to our lightning round of questions, like, let me just ask you one more final question. If there's anything you felt like you didn't bring up here on it, but again, from a seller's perspective, like, what can they do from a tax perspective to make themselves look and do it as in advance as possible, not like last minute?
Mhm.
What can they do in advance to make themselves as attractive as possible to a buyer on that tax perspective?
Sure. I mean, if it's a C Corp, which is the one you'd really be working on for that, at the beginning, you normally want to file an 83B election. I don't always recommend it for everyone, but if you do have that intent to sell the business and you do have a vesting arrangement between yourself and the founders and the business, then the 83B election actually protects the company from needing to do the like regular valuations in order to calculate if there's any liability on earning those shares of the value in the company. So that can be a really good item to, protect against liability. Stick to an address in your incorporation state unless you have team members physically in another state, then you have to register in those states, do everything correctly from the beginning. And most importantly, make sure you file all your taxes. File your federal income tax every year, your Delaware franchise tax, because there's nothing that scares a buyer or scares their legal team more than when they dig in and find, oh, this never got filed, right?
Yeah, for sure. A great answer. I think it was smart to end on the common wisdom of just filing your taxes because I do feel like that's like the big. I mean, it's not nearly as bad as people make it out to be, right? It's like there's one of those things we make it into this big monster. And we're like, oh, I
Yeah.
will eventually fight that thing. So yeah, I think that's smart to end it on that way. So we're at the ending of the podcast here, Crystal. So I have three rapid fire questions for you. Are you ready to answer these?
I'm ready. Let's do it.
Great. And since they're rapid fire, that leaves it open for you to be vague and a tax lawyer getting really mad at you considering the topic of this conversation. So no pressure.
All right. All right.
So my first question for you is what are the best hidden business opportunities from a tax perspective in today's landscape for buyers and sellers?
Oh, well, I mean, I'd say anything in the AI space right now because there's so much ability to apply AI technology and create new business models that are both, extremely fast to scale, very easy to sell, and, very tax friendly because AI, doesn't live anywhere. So.
I love it. What tools or resources can entrepreneurs use to help them navigate their business taxes?
Well, that's tricky because you have to be careful not to trust a lot of the information online, especially now with ChatGPT. We actually had a client run their tax return through ChatGPT,
Oh,
and
wow.
the information that came out was so wrong. It's kind of amazing. And we've had content writers also that we hired who, like, I look at it and I've played around on ChatGPT for tax info. And like I can recognize it. Like you guys put this through Chat GPT. Like, why are we paying you for this? This is so bad. It's like full of misinformation and outdated information. So, I mean, I could definitely tell you that's a resource not to use. The IRS website has gotten a lot better in recent years. So, most of the information on there is accurate, but even now, you can't actually rely on anything on the IRS website. So, the best thing to do is to hire a professional,
Go
unfortunately.
to Clear
You know?
Tax.
Yeah.
That's the resource.
Sorry.
Hit up Crystal on LinkedIn. It will help you out.
Yeah.
All right. My final question, and perhaps the most important question that I've asked you throughout this entire podcast. What has been your funniest moment helping entrepreneurs with their taxes?
Oh, my funniest moment. Well, I mean, it might have been the guy running the tax return through ChatGPT. That was extremely frustrating, but quite funny. Let's see. Oh no, we had one client recently who couldn't believe that bookkeeping was required for his company in order to prepare the taxes. And he kept saying you need bookkeeping, like you need to like at least have like a spreadsheet of your income and expenses. And he kept sending us the bank statements and saying, well, you're accountants, can't you count? So,
Solid logic. Yeah. Solid.
yes. So yes, we can count. I'm very good at math, but no, I'm not going to go through your bank statement for you item by item. If you need that, there's a separate service called bookkeeping. We do offer it, but it's not like It's sometimes it's the expectation, right? It's like you
Right.
come
Yeah.
to
Yeah.
tax experts because we're experts in tax and the optimization and getting you the best, structure, best situation, best outcome for your company. It's not because we do data entry and put things on forms, right? So,
That's funny. That's just like one of those expectation things, like, oh, you're an accountant, so obviously you must do this. Like, well, yeah, but a different service you must pay me for. What? We've had stuff like that at EF where people think we do due diligence on businesses that we sell, but I always like vehemently tell people we do zero due diligence. We do vetting, which make sure that as a legitimate business it is doing what it is saying it is doing, right? But
yeah.
due diligence is like a very personal thing, like. And like I've had people come up to me like, "Oh, why would EF ever list this business as declining from this Google penalty or this Amazon issue?" It's like, well, some buyers like that. Like, obviously, you're not one of them. But that's like due diligence, Like that's up to you to decide if this makes sense for you. But yeah,
It's
that's a funny
true. It's
story
a underrated art when it comes to due diligence on any
for
kind of
sure.
purchase. Buyer beware, right? So,
Right. Yeah. I always joke with my team, like from a marketing perspective, like I call it the big filter. Like, what do you sell for us as businesses? Who do you sell to? Investors and entrepreneurs. And then like the number three part that gets to that, but like hard hitting marketing punchline. I always tell them what we really sell is an opportunity to change your life. Now, that might be an opportunity to change your life for good or really bad if things go wrong. So like I'll try to be as transparent as possible, right? It's a risky
I
endeavor, but
love that. I
yeah.
love that model. Yeah,
Yeah,
opportunity to
yeah,
change your
like,
life for good.
we're
Yeah.
merchants of change. It doesn't mean it's a positive change, though. It might end very poorly for you, so buyer beware. So, yeah.
Oh, yeah.
To be honest, I think that's, like, the best stance to take, right? Like, that we're just being honest with them. Like, I've helped make, gosh, probably over 100 millionaires now at my time at EF through buying and selling. So, obviously, it's gone well. Like, people keep coming back to
Yeah.
it, but every now and then, it's just like, "Oh my god, I just, like, burned through so much money." I was like, yeah, aren't you glad we told you not to buy that bigger business you were originally looking at?
Well, a lot of people are not cut out for entrepreneurship, and it's different at different levels, right? Like, I know myself, and I'm not good at like 0 to 1 bubblegum and duct tape to like get an idea launched and off the ground, like that level of entrepreneur. I'm good at coming into an existing business and making it like super successful and putting all the pieces into place and growing it, right? And seeing like what the risks are, where it's wrong, how we can like move forward from where we're at. But I'd say like a lot of people are on the other end and they're really good at like that ideation and like having something really cool. And then they hit a certain point where they're not able to, to grow, to figure it out beyond that. And, at that point, it's really good to recognize it and either sell your company or to be able to bring in expertise and help in all those different areas you need and tax and accounting and legal and growth. I'm also an EOS integrator, but I don't do that, professionally, just within Clear. But bringing in help like that to grow the business is, I think, something that a lot of people aren't aware of or ready for because there's a lot of moving parts
There
when you
is.
start to get into it.
Yeah,
So,
I forget the exact wording, but there's this guy, I'm forgetting who he is even, but he said as you grow your company, you have to die several times and just like completely reform the company. Like the skills from 0 to 1 are so dramatically different from like 1 million to 10 million and 10 million to 20 million, et
mm-hmm.
cetera, et cetera. So I'm with you. And I didn't expect that this podcast would end where you want to buy all the businesses on our marketplace. They are at the one stage. So I am looking forward to selling you an opportunity to change your life, potentially negatively.
You never know. You never know what the future holds, right? But until then, here to help everyone else. So,
Yeah. This has been an absolute pleasure. We'll have to probably get you on and maybe do some more content together on taxes. I think our audience would get a lot of benefit from it. But if anyone wanted to
yeah.
reach out to you and connect with you, what are the best places for them to go?
So the best is to reach out to our customer success accountants at hello@clear.tax. It's Cleer tax, right? I'd say that's the best because they respond really quickly, whereas I tend to be kind of swamped. So if you reach out to me, expect a couple days. I'm not gonna and a couple weeks for calls or consultations because that's usually how scheduled out I am on the expertise. But we have a lot of other great experts as well on our team, and we could definitely help with any of annual tax filing needs, with bookkeeping. We have all inclusive packages. We can just take care of it all for you. And that includes consultations, includes everything. So definitely here to help.
Thanks for coming on, Crystal. It was a blast chatting with you.
You too, definitely.
There you have it. I hope you enjoyed it. I hope it got you inspired at all the different things that are happening in this industry. And of course, if you just want to buy a highly profitable business, you can always go to empireflippers.com/marketplace, or maybe you want to make an exit of your highly profitable business, and you could go to empireflippers.com/sell your site. I've been your host, Greg. If you enjoyed this episode, make sure you leave a review, give us a like, a follow, share it across social media. Talk to you all soon. See you on the next episode.